Hey, what's up, everybody? It's Stephen Williams with the creditrepairshop.com. In this video, I'm going to talk about credit scores. I get a lot of emails, uh, posts on Facebook, people message me on YouTube asking why the hell is my credit score not either moving up or it's moving down, or why did my credit score boom up and it don't look like I did anything different to make that happen. And let me just break it down real quick in this video on how to increase your credit score or to find out what's going on so you can increase your credit score. This is how it's figured. It's called a FICO model. And this is a company that kind of figures everything out, and they resell it out to creditors, and they use this model. It's a mixture to see how to see a person's credit worthiness, to see if company A loans you money, what is the likelihood of you being able to pay that money back? And what they do is they put all these models together of people that have certain situations, job, income, where they live, zip code, all types of stuff, and they make these models, and companies can then buy these models, and then they can say, okay, if we get someone that fits this category for their credit scores, we will loan money to them at this rate, or if we get this one, we'll loan them at this rate. And so here's the models. Then I'm going to kind of go into what I see as an owner of a credit repair company that has seen literally hundreds of thousands of credit reports. Now, let's just start here. They're all, it's got this little circle here. How much do you owe? So they're going to look at how much do you owe compared to your income that you have. If you're pushing out, let's just give an example. If you only make $50,000 a year and you owe $500,000, they're going to say that even if you're making all your payments, they're going to put you into a category of where it could be a high risk category, because you're probably on the limit of not being able to keep your household in order and to make all of your monthly payments to the creditors that you owe. But the way that they're going to figure that out to make sure of it is they're going to look at, number one, so we looked at how much you owe. The next one is they're going to look at your credit mix, which is it your house, you have cars, credit cards, department store cards, payday loan, all this type of stuff that's reported on your credit report. That's a 10% of figured in 10%. How much you owe is 30% of how they figure it. The length of credit history, how long you've had accounts, is 15% of it. Your new accounts, if you had new accounts that are popping in, 10%. And then your payment history is 35%. Now, when they look at how much you owe, well, let's look at when they look at how much you owe, and they compare that against what your credit utilization, which is how much you owe and how much you're using of your available credit. That's what I think is probably, other than payment history and not having collections, that's what I think when I see stuff, that's one of the biggest problems there. Because what in the past, what they used to do is they used to base it off of if you just made payments. They didn't care if you out of all of your money, you only had like $1,500 or $1,000 or $500 left after you paid out everybody. They didn't care. As long as you were making all those payments, they didn't care. Well, after the downturn in 2008, what they started making these companies do is they start to say, can they afford to take on another payment? So now you don't see as many foreclosures as there used to be, because they will not let someone get a house without them being able to sustain themselves to run that house. They just won't do that anymore. They used to just give people houses, and they would give them interest-only loans, and then when those things turned on people, they couldn't even afford to live in that house. They couldn't afford the payments because they couldn't afford to eat, pay the light bill and the water bill and groceries and the other stuff, when that interest only payment had to flip over into them making a regular payment. They cannot even make that type of loan now to someone in a house. They would still have to figure out if they're able to afford it, and they usually want you to be 45% or below. And that just makes a more safer loan, and they're running those models. But so when I look at things, they're looking at what you owe and what types of that you owe. And then when it comes to credit cards, they're looking at how much are you utilizing. If you have a $1,000 available credit line on or $1,000 credit line, they want to make sure that you're only using like 30 to 40% of that, because they feel that if you're maxing out that card, unless you're paying it off every month, if you're maxing it out and you're carrying the balance and you're making the payments, that could put you into a category of struggling to pay your bills. And they're running these models. Other models that they're starting to put together too is they're starting to throw the your health into it. So what they do, it's not actually being reported on there, but they're starting to add that into there. So when you're filling out the paperwork at your hospital, they're making you sign these disclosure forms. And what they're not doing, they're not saying your name when they sell it to the bureaus. What they're doing is they're just putting you into a profile pool. And when you get into that profile pool, even though it doesn't say your name, the way that they figure it all out, you end up being into that pool. And when someone runs your credit, they will know either by a code or something, some sort of pool that you are rated in when it goes to how you're, some type of pool that you're being rated in when they look at your ability to repay a debt. And you can look at what's being done with insurance. Insurance companies do this all the time. If an insurance company rates your credit and then the insurance company gives you the credit, what's stopping the insurance company from selling your information to the bureaus to be resold or directly to companies? See, that's what I'm saying. All of this is about data. The bureaus are about giving data. Companies are about giving data, and they're making millions of dollars selling our data to other companies, and then the companies are formulating this data, and then they're making determinations on how they would loan money out to us. Other things that I've seen when it comes to holding the credit score down is zip codes. People say that this is not true, but I know that it is true because I've seen clients that live in one zip code and another zip code. Almost everything matched on their reports, and people in this zip code had lower scores, and people in these other zip codes had higher scores. I don't know why, but I see this with a lot of reports. Other things that I'm noticing on the reports, and people didn't believe me when I had a video about this, was any type of criminal history is being reported. They're taking it off of the applications, but they're allowing it to be placed on the credit reports. If you have multiple, now think about this. It goes back to what I just said about the insurance companies. How can a company that's going to loan you money know about your criminal history or know about your if you have multiple violations and you're a high risk type person? Well, insurance companies, they get that information from the courts. They rate you on your insurance. Insurance companies sell that to lenders, and then right there they have it. And so you could see the trail of how they could get this information, put you into a pool, and say, well, we're going to rate you at this amount because of what we see on your reports. And also, when it comes to credit reports, lenders get a different report than the one that we get from the bureaus. if you ask anyone that's in the lending business, and they'll tell you that a credit report that they get, they're not even by law allowed to give us that report. And because it has information on there that you would not believe they have. I mean, it goes into way more detail than you would think. With some people, what I think is that when they see that report and then they come out to say that you've been accepted for a loan, and they have an attitude like they're doing you a favor to give you a loan and to have you pay back them the money with interest, like they're doing you a favor, it's because they've seen stuff on your credit report that would probably be embarrassing if they were to reveal it to you and they had that in their back pocket. So if you have any questions or comments, type them in below. We got to get very active, and really, it's like we're at war in a way with these companies, and we have to make them do the right thing, and make them do the right thing, but also equip ourselves with the knowledge on what to do and how to play the game, because the game can be won, but you have to know the rules of the game. This is Stephen Williams with thecreditrepairshop.com. Until next time, thank you.